In the studio with me is Ursula Maritz from Southern Charter. She's the CIO at that institution. And Captain Maritz, yeah, the market, the waters are a bit choppy, aren't they? I mean, I'm looking at my screen now. 21 points down on the S&P, 1844. It was 1890 on Friday. We had a relatively good number from the United States in terms of jobs on Friday, but the market didn't like it. Suddenly, as May looms, the markets are becoming not unnavigable, but certainly choppy, as I said.
It's not unusual for the markets to trade like this. It's very much a pattern that we've seen over the last few years. Markets, particularly mature bull markets, don't go up in a straight line, and the investors will be looking for, you know, either negative or positive news. You've had issues around Ukraine, which I think has dominated the market today. So it's not an unusual pattern. There are always issues out in the market, and investors are either in kind of a risk-on or risk-off frame of mind.
It's my contention that things like the Ukraine are adopted by the market in order to justify the fact that they're selling. But we know that stock market valuations, company valuations, are the thing that really drive the markets in the long term. We've got the US earnings season just upon us. When you look at asset classes rather than individual stocks or individual bond issues or whatever, what is the asset class allocation that you have at the moment at Southern Charter?
We favour global equities in particular. The valuations there, although they're obviously more stretched than they were a year ago, certainly aren't in bubble territory. In particular, earnings are going to be very supported by improved economic growth in the US, improving growth in places like Europe. So the earnings are there to support the valuations. Clearly, some of the risks are potentially rising interest rates down the line. The margins are sort of at peak levels. But overall, we prefer global equities. Local equities are looking pretty stretched, although it really is within the local market a stock-picking market. Things like resources, construction, those are the sectors that are looking interesting.
People were talking about on Friday afternoon, South African time that is, about another migration. We had talk of the great migration from bonds to equities recently in anticipation of interest rates rising and there being tapering in the United States. Now they're talking about the migration from the high flyers, the Netflixes of this world and the Nasdaqs of this world and the Facebooks of this world into value. Do you see that as well?
Yes, we do. That's why we've actually added resource stocks, a direct holding of resource stocks into our funds. I think that we'll get a real kind of a stronger run in resource stocks once there's clearer direction from China. Because at this point, China is quite confusing. You know, are they tightening? Because they're tightening their credit conditions, yet they've committed themselves to 7.5% growth stimulation package in March. So I think once there's more certainty regarding where China's going, we could see resource stocks, particularly like value run. So we are favouring more value-orientated stocks.
It's interesting as well, the psychology of the market, as I said. The market can use anything as an excuse either to go up or down. If the market is in bullish mode, it will say stimulation package from China, albeit a small one, is very good psychologically for the market. On the other hand, a pessimist, and there are a few of them on the screen at the moment, might say the fact that they have to stimulate tells you that they're slowing down. Where do you stand?
We believe that there's an underpin to Chinese growth. The long-term structural trends like urbanization, growing population, shift away from investment growth to more consumer-orientated growth, those things aren't going to change. And that these are more kind of cyclical trends that we are seeing. So we probably more on the optimistic side than a lot of the pessimists out there. But people are also taking profits. The markets have run hard. So, this is a reflection of some profit taking as well.
So nothing to worry about at all.
No,
you favour global equities, but global equities is a giant asset class. United States of America, China, other emerging markets, Europe. What do you like?
We like the Eurozone. The European stock market valuations are looking attractive there. Growth is also improving there. I think we have some concerns around the Japanese market. You'll see there's almost 100% correlation between the Nikkei and the yen has been pretty weak, and it looks like it's going to stay weak. So I think there's still pressure on Japanese stocks, for example. Although at some point clearly they will become attractive. I think emerging markets are slowly becoming more attractive. They've had a big blowout. And the growth potential is still in those markets, although Clearly, they've got some high current account deficits and those types of issues. The growth potential is there, so we would even start nibbling at some emerging markets.
What about emerging markets, African emerging markets? We've just conducted a fascinating interview with a Nigerian gentleman, a proudly Nigerian gentleman, and of course you know what exactly happened. What happened yesterday with the rebasing of the Nigerian economy, up 89%. Is Africa on your radar?
It is on our radar. It's quite, in terms of fund of funds, it's quite a difficult thing to kind of get access to. There are some African funds. The problem is there's huge volatility in those stocks. So we would look to add in our portfolios, but more in our high-risk portfolios, where those particular clients can withstand the type of volatility that we see actually in those markets. But there's actually, there's a huge potential.
I hope so. Hopefully it'll also filter down to here. What about other asset classes now? What about bonds and property? I mean, the bond market confuses me completely.
Yeah. I think the bond market is kind of the biggest challenge for any asset allocator at this point, because you had a massive correction last year with the announcement of tapering. So you had the correction, then bonds have kind of moved down, and in the US bonds have really moved sideways after a little while. And the question is, how much is the short rate hikes coming in 2015 priced in? Yellen did kind of inadvertently announce that you're going to get rate hikes sooner than expected. And there wasn't much of an adjustment in the bond yield, and our bond yields have actually rallied. So it's one of the biggest challenges. Our bonds look kind of attractive, around 9% on the 10-year bond. So we would look to add bonds if they push back up, and I think US bonds around 3.2, 3.3.5 would look attractive. But it is the biggest kind of challenge out there, I think, is trying to cool the bond market.
And property, we had a listing on the JSE today, and you don't want to talk about stock-specific stuff, but this was a listing at £7.52, or the share was priced at £7.52. When I spoke to the CEO mid-afternoon, it was a rand higher than that. Suddenly, property is back in vogue.
Well, property is very correlated, obviously, to the bond market. It does look attractive. You've got to underpin a very attractive income distribution of probably 6.5–7%. The vacancy levels have come off. You just got to take into account how much sort of capital loss risk is there if you have a pushback up in bonds. But there are certain stocks that look attractive, and we are looking to add back to property as well. Because I think over the 2 to 3 year investment horizon, it'll probably do very well.
Quickly go back to equities before we leave this, 30 seconds. So you don't see any problems at all? We might get a little bump here and there because of a geopolitical event or because of the sell in May and go away phenomenon, which has been done to death, but otherwise just buy the dips.
Buy the dips, because I think looking back in 12 months' time, equity will be the place to be. That's certainly where we're seeing the performance coming from, and where we've positioned our portfolios is towards a more equity-favoured sort of asset allocation.
Okay.